Welcome to this explainer. Look, today we're tearing apart a highly specialized, completely anonymous expert report focused entirely on offshore financial compliance. We're going to strip away all the surface-level noise and look specifically at the raw mechanics of foreign bank account reporting. We're talking about uncovering the precise regulatory triggers, the hidden traps that catch people off guard, and the incredibly high-stakes penalties involved in global wealth management. It's a fascinating look at how this system actually operates under the hood. To really deconstruct these mechanisms properly, we need a rigorous approach. So here's how we're breaking this down. We'll start with the regulatory baseline, then move into the actual mechanisms of FinCEN Form 114, look at global taxation and exclusions, dive into the penalty matrix, and finally wrap up with strategic compliance. All right, kicking things off with Section 1, the regulatory baseline, legal versus illegal offshore frameworks. First things first, we've got to establish a fundamental baseline here. Simply possessing an offshore account or a foreign trust, that is entirely legal under U.S. law. There's no issue there. The regulatory breach, the moment you cross the line, only occurs when these vehicles are weaponized for asset concealment. We're talking about the illegal process of obscuring income sources to deliberately evade taxation. So the explicit intent to deceive is the absolute dividing line. And to prevent that kind of concealment, the expert analysis points out that the whole system is anchored on incredibly strict reporting rules mandated by the U.S. Treasury Department. Transparency isn't just a suggestion or a best practice in this framework. It's a hard, mandatory requirement. It's specifically engineered to give federal agencies a clear, unobstructed line of sight into global financial holdings. Moving right along to Section 2. The mechanisms of FinCEN Form 114, or as we're calling it, deconstructing the FBR trigger. $10,000. That is the magic number. It's the exact mathematical trigger point where your regulatory obligation officially kicks in. The second your assets hit this number, boom, you are immediately pulled into the FBAR reporting matrix. But how this specific number is calculated, well, that's where people make some catastrophic errors. Because the crucial detail here, the thing you absolutely cannot miss, is that this is an aggregate peak value. It is not the balance of a single account, and it is definitely not your neat and tidy year-end balance. Think of it like this. If you have 3 separate foreign accounts and their combined balances peak at $10,001 for literally a single day out of the entire calendar year, that reporting mechanism is irrevocably triggered. And the report gets really granular about the specific financial vehicles that you have to aggregate. Obviously, this includes your standard foreign bank accounts and brokerage accounts, but it also includes a highly non-obvious category, certain foreign pensions. Overlooking a foreign pension in your aggregate calculation is actually one of the primary causes of unintentional yet heavily penalized compliance failure. It's a massive blind spot for a lot of people. Let's shift gears to Section 3, Global Taxation and Exclusions. This is all about the interplay between reporting and tax. We absolutely need to separate reporting from actual taxation, because they serve totally different functions. Offshore reporting via the FBAR strictly tracks the aggregate asset values held abroad. It's purely informational data gathering. U.S. taxation, on the other hand, operates on a global scale. The U.S. taxes all foreign income earned, regardless of where the account actually sits. So cause and effect here, simply reporting an account on an FBAR does not somehow magically exempt its income from your U.S. tax return. To be incredibly precise, the report specifies exactly which types of passive income generated in these offshore vehicles must be actively declared. If your foreign accounts generate interest income, dividends, or capital gains, that money is absolutely subject to taxation. You just cannot shield passive asset growth simply because it happens to be sitting in a foreign jurisdiction. Now, there is a specific, calculated buffer for people who actually work and earn money abroad. For the year 2025, the foreign earned income exclusion amount is $130,000. So if you're actively earning income overseas, this exclusion shields that specific portion of your active earnings right out of the U.S. tax net. But hold on, because we need to deconstruct a really dangerous misunderstanding right here. That exclusion applies strictly to foreign earned income. It does not apply to the passive income we just talked about. And even more importantly, qualifying for this tax exclusion does absolutely nothing, zero, to negate your FBIR reporting requirement. Even if you owe literally zero taxes because of the exclusion, if your aggregate foreign accounts peak over $10,000, filing that FBIR remains entirely mandatory. Which brings us to the highest stakes part of this report. Section 4, the penalty matrix, the punitive cause and effect. The data maps out a really stark escalation in consequences. On the standard level, simple negligence or an unintentional failure to file, you're looking at severe fines and audits. Pretty straightforward. However, the matrix escalates exponentially when you hit a severe escalation condition. This is strictly defined by the intersection of a willful failure combined with a pattern of illegal activity that exceeds $100,000 within a 12-month period. You cross that specific threshold, and the regulatory action shifts instantly from financial penalties to criminal prosecution. Let's isolate exactly what pulls that trigger. Criminal escalation doesn't just happen by accident. It requires a demonstrably willful failure to file the FBR, specifically while you are actively violating another U.S. law, or as part of a compounding pattern of illegal financial activity. This framework is highly engineered. It's designed to ruthlessly target individuals who deliberately construct complex systems to evade the law. If you trigger this severe escalation, the financial impact is just devastating. The maximum fine for this level of willful, compounding noncompliance, $500,000. It is designed to be unapologetically punitive. But realistically, $500,000 is just the preliminary phase. The ultimate penal consequence for this level of offshore tax fraud is up to 10 years imprisonment. 10 years. I really want that gravity to sink in for a second. This absolutely proves that offshore compliance is not merely some administrative checkbox. It is a strict legal mandate, monitored and enforced by the absolute highest levels of the federal government. Finally, let's wrap it up with Section 5, Strategic Compliance, operationalizing the framework. So how do you actually build an airtight compliance architecture based on this report? It requires strict adherence to 4 mechanical steps. Step 1, conduct a comprehensive audit of all your global assets. And yes, that includes non-obvious accounts like foreign pensions. Step 2, calculate the aggregate peak values of all those accounts at any single point during the calendar year. Step 3, actively declare all offshore passive income on your tax returns. And Step 4, automatically file FinCEN Form 14 annually if that peak aggregate value breaches that $10,000 threshold. I want to leave you with a really critical, actionable question to end this explainer. Does your personal offshore compliant architecture accurately account for aggregate peak values across all foreign asset classes? Don't just rely on assumptions here. Take the time to analytically assess your own regulatory exposure based on the rigorous, uncompromising standards we've deconstructed today. Thanks for joining me for this explainer, and I'll catch you in the next one.